All right, we're right at 11 Central. I know we still got quite a few people piling in. At least we can see our numbers going up. I guess if nothing else, we'll start as punctual, and hopefully the rest of this goes just as well as how quickly we start on time. But those that are going to join a little late, we'll go through intros, and hopefully you won't miss much of the meat of the conversation. So. Good morning or good afternoon, everyone. I'm Brad Long, Managing Partner and Chief Investment Officer here at Fiducient Advisors. I'm joined by Sabrina Bailey, our CEO, and this is our 2025 outlook, where we'll go through a couple of key primary things. First is to give a quick update on the firm, and then second, to talk about our 2025 allocation and positioning, and read the tea leaves the best that we can for you all into the future. Couple of admin things before we begin. So we've got 45 minutes. We're going to be moving quickly. If you have questions throughout, just put them in the chat queue. We will try to get to them as we go. We'll reserve a little bit of time at the end to address questions. If we don't get to it, no worries. Reach out to your advisor, send us an email, and we'll get it answered individually. The second is for those of you that are CFPs, we're offering continuing education credit. We will have a link in the chat. Feel free to fill out that form. We'll make sure that comes your way. So, with that, we'll get rolling here, and I'll turn it over to Sabrina to give us an update on Fiducient.
All right, thank you, Brad. Good morning, everyone. We're grateful to have you with us today. In terms of the firm update, I just want to start with our missions remain steadfast for almost 30 years, which is to help our clients prosper. And we accomplish this by focusing on our core expertise, which is serving middle market institution clients, financial institutions, families, and individuals. Our team is structured with experts dedicated to each area of service, tailoring our needs to each of those groups. In terms of a snapshot of our firm, today we have over 200 associates that span varying disciplines across investment consulting, research, analytics, operations, technology, compliance, and client services, to name a few. We are also proudly serving over 1,200 clients, including defined contribution plans, defined benefit plans, endowments, foundations, families, individuals, and financial institutions. In total, this represents a combined assets under advisement and management of $330 billion across 47 states. And then notably, 20% of our employees are firm owners, with a robust pipeline of next generation leaders coming behind. All that's great, but why does it matter to you? It matters because we view your challenges as our challenges, and our success is directly tied to your success. You have direct access to a breadth and depth of expertise from a team that's passionate about helping you succeed. Whether you're leveraging our internal capabilities, connecting with industry experts, we're here to help provide solutions tailored to you. We are also excited to say in 2024, we've achieved some key milestones. So we have experienced organic growth across all of our business lines, adding more than 125 new clients over the year. We also launched our first annual client survey in over 5 years with excellent results. This is important because it allowed us to hear directly from you as our clients in terms of what you're thinking about, what areas we're doing well, and then how we can continue to enhance our services as well as our solutions going forward. So thank you for all who participated in that. We'll look forward to sharing more with you in 2025. Speaking of new solutions, in 2024, we introduced several new offerings in response directly to client needs. We launched a financial wellness solution that's dedicated to helping employees take ownership of their financial outcomes, a pooled employer plan solution for retirement clients that are seeking to move in that direction, financial planning services for executives across our client base through our executive CFO program, as well as new investment solutions tied to the alternatives asset space that help our clients access alternative assets in a scalable way. Just to note, your feedback drives our best ideas. We're here to listen. Your advisors are here to listen. So if there is anything else that we can assist with, don't hesitate to reach out to us. In addition to new client solutions, we've been investing in our people and our culture. From a colleague perspective, in 2024, we launched a career pathing initiative that provides greater line of sight and growth opportunities for individuals across our organization. And we introduced our firm's guiding principles of uphold excellence, embrace growth, demonstrate care, and cultivate joy to complement our values as serve as cultural pillars of our firm. We also continue to invest in technology to maximize the time our team can spend on their most important day-to-day value add areas, which is serving you and connecting with you as our clients and partners of the firm. And then finally, we remained actively involved in our communities through our volunteer days, as well as our nonprofit board efforts across our leadership team. Looking forward to 2025, we're excited that we'll be announcing new partners and principals in the coming months, so be on the lookout for that. We also have a focus on continuing to serve our clients and communities, as well as deepening partnerships across the industry. And in September, we're hosting our annual client conference in Boston, and we'd love to see you there. In closing, thank you all to clients, colleagues, partners for your unwavering support in 2024. Without you, success is not possible, and we're excited to deepen our relationships and partnerships with you in 2025 and beyond. And with that, I will turn it over to Brad to give our academic outlook.
All right, here we go. Buckle up because we got a lot to cover and a fairly tight amount of time to cover it. This is always the one where we try to squeeze, 3 pounds of stuff into a 2 pound bag. So again, if we're going quickly, feel free to throw a question in the chat. We'll get to it, or we can get to you after. So very briefly before we go into our outlook, maybe we'll start looking in the rearview mirror. Our 2024 outlook and allocations really talked about 3 primary themes influencing markets. The first is this idea of messy middle inflation. And, look, inflation did moderate. There's no question about it. I think the messy part of messy middle will be a more prominent discussion in our 2025 allocations as we talk about the potential risk of reignition of inflation. Prepare, not predict. Remember in 2024, we were coming off the year of 2023 as it's the year of inevitable recession. It wasn't an if, but a when. Here we are 2 years later, recession, no year in sight. And if you were one of the many investors that went to cash and said, hey, pick your favorite reason to be bearish. Maybe it's a general election, full valuations. 2023 and 2024 were both extraordinary years here in the S&P, up over 20% year over year. So that's a high opportunity cost. So that's not a 2024 theme. That's a secular piece of advice of let's prepare portfolios, not predict future outcomes. And then concentrated consequences. Look, the handful of stocks in the S&P 500 that have been driving returns, they've done nothing but continue to add more and more value. So maybe as futurists were saying, maybe we're not wrong, but we're early. But we'll respectfully roll some of those conversations from 24 into 25 and talk about how they're going to be influence our portfolios and construction. So those of you might have seen that read our content, we released our 2025 outlook in the latter parts of last year. It's entitled Bridging the Divide. And the 3 things that we think, really encapsulating, where we're moving portfolios and positioning and driving those themes are the following. The first is fragility. So you'll hear us say it a few times or many times during this conversation. Valuation, concentration, and inflation, right? Those are elements that potentially sow the seeds of volatility in portfolios. It doesn't necessarily mean that 2025 markets will be down or that the Mag 7 will reverse, but starting from a position of full valuations means expectations should be falling. Concentration means that we do have potential greater variability, and inflation. We'll talk about, how that's going to impact various asset classes and risks. Now, the result of fragility means the intentionality around durability is even more important than it's been in years past. And we'll unpack a whole lot of components around that, whether it's stock and bond allocations, which are a very important component of durability, or it's geographically how I'm positioned, how I'm positioning real assets, the duration or the credit quality of my fixed income portfolio. So, all of those collectively are the intentionality we're describing when we talk about managing towards durability. And then the age of alpha, this idea of in an environment where valuation concentration and inflation risks are high, there is, we think, a disproportionate opportunity in alternatives, whether that be hedge funds, whether it be private markets, et cetera. It's worth noting, right? As Sabrina said, we exist here to make sure or to help you achieve your financial goals. We don't make any more money if you're active or passive. If you own alternatives or don't own alternatives, that's not, our bailiwick. all we're talking about here is how do we build a highly probable portfolio to achieve outcomes. So, I want to say the quiet part out loud, perhaps, and that, as we're talking about that idea of alternatives, it's not coming with an embedded bias. Now, before we get into kind of some of the depths of that theme and unpack, where we're allocating portfolios, when we talk about, allocations, right, we are market allocators. We're not economists, right? We're not political strategists. We'll talk about politics in just a moment. But it's important to set the backdrop of the economy and how that's positioning and how that's influencing our investment committee. So we'll start here at kind of the cruising altitude of 30,000 feet. We'll slowly work our way down into portfolio allocations and on a net basis where we're moving capital. But starting at that 30,000 feet, we want to just talk about the economic backdrop. And, Strategas, actually, it's a sell side investment shop. They make economic and market-based predictions, and they have a diffusion index, which frankly is as succinct and as straightforward as a way to evaluate kind of the global economic backdrop as we can think of. And they take 14 important, somewhat disparate and meandering components of the global economy and rank them as either assets, so that's good, liabilities, that's bad, or somewhere in between. And as you knock through these 14 different components, there's no question the economy has been growing. Often, employment is cited as one of the, primary factors of, hey, look, even much to the chagrin of economists, the economy has remained very robust and continues to grow. And we can see that certainly looking back in the rearview mirror. Now, as we look at, all these different categories, you notice there's a pretty big stack here in the middle. There's more assets than there are liabilities. That's reflective of a growing economy with, at least today, fairly stable prices. And if you're in the bull camp, you're really trying to move the middle of this column to the left. If you're in the bear camp, you're trying to move the middle of this column to the right. As you note back to our components of fragility, right? It doesn't take a whole lot to either tip into that bear camp or tip into that bull camp from an economic basis. And so as we think about that positioning, that underpins that idea around economic fragility. So is the economy growing? Absolutely, yes. Is it a robust freight train that's going, 70 miles an hour and cannot be derailed no matter what? No. That is not how we characterize the current state of the economy. And so, this helps underpin that general idea around fragility. Now, as we think about the potential changes that are coming down the pike that could move some of these policies to the left or right, you'll notice here trade deficit and government deficit and inflation. Those are important for the coming administration and their potential policies. Now, you all, if you know us, you've read our content, you've heard from us, especially in the year of 2024, a general election year. We're not political strategists, and we think there's politics, policy, and markets. Politics is largely what you say or do to get elected. Policy is what potentially actually influences the economy and markets. And then there's prices that move up and down every day. So we are not here to say, even though we're on the precipice of the new administration coming in and all the potential changes, we're not here to try to read tea leaves on what was said on a campaign trail versus where prices immediately move. But our investment committee is responsible for looking at the incremental changes in policy and what that potentially means to portfolios and overall potential risks. So as we went through, a lot of the potential new administrative changes on the horizon, we focused our attention on things that are executive order functions, right? Where the new administration has either unilateral or material control over influence in actually taking politics, what was said, to policy. Not that legislative functions aren't important. The tax policies in 2025, the TCJA, the Tax Cuts and Job Act, that's going to be a really important discussion. It's set for expiration at the end of this year, but that takes an act of Congress and Senate to influence the change in that policy. So for now, when we're looking at what the administration has said versus what it will do, we focused more of the conversation on the executive order functions. Honestly, we could probably spend an hour on this page just alone. We don't have the time for that, nor is it the most important thing to discuss. So we'll move through these fairly briefly, as we know there's a lot of questions that are likely going to come this way. The first is around tariffs. Tariffs, all else equal, and this is an oversimplified and stylized example just to keep time fairly short, is they tend to be inflationary. Why? When the United States implements tariffs on, call it a foreign nation or an entity, they tend to be retaliatory. So they will implement a subsequent tariff on us and our goods. Those goods or those effectively taxes tend to be passed on to consumer via higher prices. Now, there have been points in time where tariffs have not coincided with high periods of inflation, and where modest tariffs have coincided with periods of material rising inflation. So it's not simply just tariffs being on or off, but all else equal, we'd consider tariffs to be generally inflationary. And as we talk about, potential risks, and we talked about inflation as one of them, that drives in that direction. Now, there is still questions outstanding of whether the new administration has the executive authority to implement tariffs unilaterally, right? There's precedents for the International Emergency Economic Powers Act of 1977 or the Tariff Act of 1930, but there are challenges against, some of which, ironically, the first Trump administration, through their Supreme Court nominations, sowed the seeds for enacting some of the challenges against, most notably Chevron deference, in which some of the entities in which the administration would use to enforce some of these policies do not have the same authority to interpret what those actions are. So time will tell. We will certainly monitor here which tariffs are in place. The level of tariffs will all matter greatly. And as that information comes through, to the degree it makes sense to adjust to it, we certainly will. Politicizing the Fed. This is another one that's out there, kind of maybe largely lives in the Twitter universe today. Luckily, it's not something we have to address at this very moment. Fed Chair Powell's term is up in May of 2026. However, all else equal, whether it's this administration or any future administration, hopefully they appreciate the true independence and the value of the Fed. The Fed, in theory, has two primary objectives: full employment and price stability. If you're someone that's an entity, an individual, a foreign nation that's buying treasuries, translating those two objectives is, what's the probability to get paid back? Because remember, the United States has one source of revenue. If it were a company, it would be sales, and that's the taxation of its citizens. So full employment helps that. And price stability means any debt that I buy from the Treasury isn't going to be deflated away in the value eroded because of inflation. So the United States here today sits at 120% debt to GDP. 34% of our treasuries mature within 1 year. I think it's just over 50% within a 3-year window. So any material move upward in funding rates as interest rates are rising, because the idea that the Fed is no longer apolitical, it's political, that's going to be a higher cost of funding. And that's not something that the current or any future administration wants to deal with. So our hope is cooler heads prevail there, but we'll wait to see how that plays out for the remainder of this year and into early next. Bit of a grab bag here on other components. Foreign policy, obviously the Middle East, Taiwan in particular, with some of U.S.-China relations. Basel III deregulation, which will be interesting. M&A. So Lena Khan has not been a great friend of the markets as the head of FTC. She'll be moving on. So, some other potential impacts there. You can kind of bucket these next two: deficit and DOGE, the Department of Government Defense or Efficiency, sorry. Perhaps taking the latter first, DOGE. Total wild card. Maybe it actually is effective in creating government efficiency, where fairly objectively the government, even just through lines of legislation, has grown more bureaucratic over time, really since the times of Reagan. There could be opportunity for advancement there and efficiency. Practically, I think outside of deficit spending, when you look at really affecting spending in the United States, you're talking about entitlements, and entitlements are a third rail for both parties. So we'll see how that actually takes place. Now, when we talk about deficit policy, long term, it's clearly something we need to address. Short term, there's actually a little bit of noise here. So in January, we are going to hit the debt ceiling. That means the Treasury can no longer issue debt. So they may go through a partial shutdown of the federal government. And what effectively happens is the Treasury starts paying its bills through the piggy bank. That's the TGA, the Treasury General Account. What that effectively does is it moves money off of the Fed's balance sheet and into the banking system, and it acts like quantitative easing. So when we talk about kind of, inflation or inflationary pressures, there's another, somewhat technical component to deficit in the short term. And then finally, immigration. Immigration is a potentially material and impactful component. And again, it's a very important issue. But when we're talking about just through the lens of markets, we have a very tight labor market today. Unemployment is low, and one of the primary inputs to price volatility, inflation, is wages. If we were to go through some sort of deportation, right, from the estimates of 1 million to 8.3 million people, effectively you're stripping labor from the economy. That is going to have an influence on prices or wages. Wages can have an influence on prices and generally could be inflationary. The other is less draconian, but more long term on just immigration and customs reform. Look, the practical side of this is the United States labor pool, domestic labor, is not growing. Actually, according to the Census Bureau, it's falling by about 0.3% per year over the next decade. And so to have a productive, growing economy with GDP growing, unless you can think you can grow the economy just by productivity, things like AI, you need more labor. And since 2022, almost all of the labor growth in the United States has come from foreign labor, which is about 24% of the total labor supply today. So any material impact to immigration, i.e. labor, in a period where inflation volatility could be rising, could be material to inflation and prices. Now, look, there's more to inflation in the economy than just the new administration. But as you can see, as you start to tick down this list, and our investment committee thinking about the potential impacts for 2025 and beyond, it does skew risks in certain ways. A pro-growth administration is also a potential inflationary administration because those are flip sides of the same coin. So now moving from economy at 30,000 feet to the administration at maybe 25,000 feet and getting back, diving into some of our key themes for 2025. And we want to unpack fragility a little bit. And we talked about valuation, concentration, and inflation. And in concentration, I think most know that markets are concentrated. Today, the S&P top 10 accounts for 40% of total market cap. But I don't know if a lot internalize what the actual impact of that is. And so, the Long family, as we were on holiday break, we were in airports. And I think of concentration like a moving walkway, right? You're exerting the same amount of effort, but you're moving forward a lot faster. That's concentration when it's a tailwind for you. Now, if you're my 7-year-old and you turn around and you try to run against the moving walkway, that's concentration working against you. So there is a pretty material impact on concentration when we just look at the overall return of the index. So we mocked up a couple just stylized examples to help illustrate the potential impact of concentration. So in this stylized example, what happens if the top 10 return exactly zero in 2025? And the rest of the index, all other constituents, return that prototypical 7% long-term return. Well, even though 98% of the index by count returns 7% and the top 10 returns zero, the top line return fell by 40% from 7 to 4.5. So you start to get the sense of, what is the impact of having a concentrated top line. Now, what would it take to erase the total return of the top line index? So at the top 10, we're down just 13%. Everything else is up 7, the index breaks even. Now, 13% is a very achievable down number for some of these stocks. NVIDIA was up 204% last year. God forbid if they were to miss earnings, 13% is a drop in the bucket. And so this idea that, concentration can have material influence on the headline index return is quite real. And, we pulled out, what would it be, a 5 or 3%, but you start to get the idea of what is the impact of concentration? Now, beyond that, right? So you're like, great, I hear you. Concentration is important, but what's going to happen to the top 10? I mean, look, that's truly the trillion-dollar question. If we try to zoom out and don't just, look at NVIDIA, we're not here to make a call on NVIDIA per se, and look at the history behind continued success of companies, of constituents in the S&P 500. So this is looking at sales growth, either 10% 8% in a given year or 20% in a given year of constituents in the S&P since 1985. So 72% of constituents in the S&P have achieved at least 1 year of 20% sales growth. That's a fairly high number. Or 91% at 10% or more. Again, a high number. If you knock that forward just 1 year, so let's use the 20% sales growth example. So you're 20% sales growth in year one, and you again achieved 20% or more in year two, it falls from 72 to 43. And you can see that, as this curve continues to shift over time, it's more and more difficult to continue the same rate of growth that we've seen from some of these companies. Not impossible, right? The numbers on the end aren't zero, but they certainly aren't particularly high. And it just leads to this idea that, we live in a dynamic, a non, monopoly-based economy. And so, there is competitors out there, and it becomes harder and harder to keep, as the slide is entitled, the party going. Now, what the success of these companies has certainly led to in the concentration is full valuations. So remember, we talked about fragility, valuation, inflation, and concentration. And valuations are full in the US, period. This is forward price to earnings. It's, our kind of prototypical and preferred metric. We're talking broadly about valuation, but you can pull out that and add in whatever you want. Trailing PE, price of sales, price to book, EV to EBITDA. Even the conference board surveys expecting higher stock prices at all time, even more than the 1990s. So valuations are full here in the United States. Doesn't really matter how you cut it. Now, they've gotten there, and somewhat deservedly so manner. The earnings growth and the sales growth, and obviously the combination of the two is the margin of the Mag 7 has been fairly extraordinary. And this isn't the 1990s price to eyeballs, fictitious, what's the internet going to do to the earnings of my business. These are businesses that are selling products that are in very, very high demand. And NVIDIA is a prime example of that. Their backlog, their order book, and the products that they're selling have been absolutely extraordinary. And you can see that reflected in their earnings growth. But as you think about what valuations mean, it means overall, with high valuations, expectations of future return should be lower. And when you dovetail that into expectations for the Mag 7 and the S&P overall are fairly robust, right? So if we look at Q4 earnings season just started, it's starting this week, and we have obviously all of 2025 ahead of us. Expectations are pretty rosy for the continued earnings growth of not just the Mag 7, but some other constituents in the S&P 500. And remember, the playbook for 2022 wasn't that the Mag 7 or FANG M at the time, weren't growing their earnings. They were growing their earnings at lower rates than expectations, and obviously that's where those stocks began to trade off. So let's put those expectations, in this idea of fragility in context, right? So we're in a cutting cycle. The Fed began with a bang in September with a 50 basis point cut. We are cutting rates today, and historically, over rate cutting cycles, when you look at earnings growth, on average, they fall by about 6%. Now, typically cutting cycles often coincide with weaker economic environments. Time will tell as we go through our full cutting cycle what the actual prevailing environment is. But if we just simply stack these two up relative to expectations, today we're in a cutting cycle where historically it's led to modestly falling earnings or variability in earnings. And today we think 2025 is going to produce 21 or 20+% earnings growth. So getting back to that, just kind of can the party keep going and a harder hill to climb? Valuations and expectations are certainly full. Now, as we zoom into that next step on themes and talk about durability, one of the first and most important components about durability is just talking about overall asset allocation. So that's largely, call it the debt to equity mix of portfolios, and it's one of the primary things that will drive both risk and return. So here we have top line, which is our US large cap minus fixed income expectations, are basically the Barclays Ag. The higher this number, the more the premium you expect from equities. The lower this number, the less the premium you expect from equities. Today we sit at 73 basis points. To find a similarly low equity risk premium in our forecast, we'd have to go back, to the year 2007. And so, as we think about the relative opportunity between equity and debt, the margin is fairly thin. That does absolutely not mean sell all your equities and buy bonds for a whole host of reasons, primary of which would come back to, prepare, not predict, right? If anyone would have done that in 2023 or 2024, the opportunity cost would have been very, very high, right? So that is not what we're to say. But what we would say is the opportunity cost between those two, maybe much to the chagrin of investors, is you can allocate to fixed income today and over a long time horizon, 10-year period, we think the opportunity cost relative to the two is fairly modest. So you don't have to take on more risk to achieve similar levels of return. The other reason, as we talk about durability, we would say, you would not want to just sell all your equities and buy bonds, is as we look at kind of the current environment for bonds. A lot of volatility, especially around rates recently. The 10-year has been moving substantially. A lot of that is linked to inflation. So as we just talked about, valuations, concentration, inflation really drives a lot of rate volatility. So here we're looking at core CPI. Obviously, this kind of mountain at the end here was 2021, 2022, and you see, the subsequent decline. Overlaying this with the 10-year Treasury and its correlation to the S&P 500, you can see that correlations have risen. And in a mathy way, the higher correlations, the worse a diversifier an asset is. The lower the correlations or negative correlations, the better a diversifier an asset is. So if we get this period where inflation expectations begin to reignite, or at least the concerns of them, or maybe just a retailoring of the expectation of the cutting cycle in 2025, correlations between equity and fixed could remain high. This gets back to that idea of the age of alpha and the opportunity for alternatives to add material value in portfolios, right? Because that environment where where valuations, concentration, and inflation are high, you're constantly seeking additional and greater diversification. So where does that leave us on a net basis for 2025? As we look to 2025 allocations, some of you will be having these conversations over the first quarter, or coming quarter. Some of you may have already had some of these conversations with our consultants, and they're reflected, obviously, in our 2025 outlook that we released late last year. We'll break this down by kind of major food group, if you will, fixed income, global equity, and then, real assets and alternatives. With the backdrop of the conversation we had around, fragility and durability, and specifically within fixed income around inflation expectations, potential for higher rate volatility. So increasing our TIPS position, that's Treasury inflation protected securities. I think you can get the intuition around that, and break evens potentially, moving with higher inflation expectations. Dynamic bonds, right? One which an allocation which can take advantage of some of that greater rate volatility and price movement intra-year. A very modest, call it, shaving of U.S. bonds or muni bonds, really just at kind of the net benefit of those other positions. And then high yield bonds and muni high yield. You see flat here. The overall yield of those positions is still very compelling, except the spread. So risk-free plus the something. The spread is what you get paid to take on the additional risk. It's very tight today. Last year, we'll call it at lows. This year, we remain at lows. Man, would we love to buy a lot of those positions in much greater spreads, but today spreads are fairly tight. Finally, global bonds. Double arrow here, we're removing global bonds from allocations in portfolios. Two primary reasons. One, just in a bubble of global bonds, so relative forward return to things like U.S. bonds or for taxable investors, muni bonds, it's just not compelling enough to continue to attract and command a high percentage of the portfolio. The second is around currency volatility. So as we, go back up to that 25,000 foot level and talk about the administration, tariffs and other policies that could be implemented could materially influence the dollar, both gains and losses. all of that currency volatility, largely be felt in global bond portfolios where it's not impactful at all on the rest of these assets in fixed income. So on a risk-adjusted basis, they're not as compelling today, nor do we have to take on that incremental risk when the benefit between the two are fairly small. When we look into global equities, a handful of things which we've talked about: valuation, opportunity, and inflation. In short, modest kind of net seller of U.S. large cap, maintaining our U.S. small cap weight, and modest increase in international and emerging markets. There's a whole host of reasons behind that. I'm sure we'll get even more questions in the queue. But if you think about valuations as a clear differentiation where a lot of the high costs, which we've been talking about, exists here in U.S. large caps. But even said quite simply, the concentration, owning a globally diversified portfolio is far less concentrated in a handful of names and or sectors than is just owning a very home country domestic based portfolio. And so for a variety of reasons, we think that improves certainly risk adjusted opportunities. And then alternatives, maybe breaking this into two components. One is real assets. A net seller of real estate or REITs. REITs did very well last year as inflation expectations or rate expectations were falling. Those are a rate sensitive asset. But moreover, as we look at the potential opportunities for what can stir inflation, those are policy or policy error or geopolitical, right? It could be the Suez Canal or the Straits of Hormuz. It's shut down and influenced supply chains. And so having a diversified and broader approach to real assets helps hedge greater against those myriad of different potential catalysts for inflation. And then alternatives, look, there's so much that goes into the nuance of an alternatives conversation. There's taxation, there's liquidity, there's administration. So we can't just blanketly say on a call with hundreds and hundreds of people, own more of X, right? It's just disingenuous to say. But all else equal, if we strip back some of those really important nuanced conversations that our consultants will have with you all, in a world in which our forward expectation on US equities is fairly modest, our expectations for kind of fragility and volatility are fairly high, and achieving kind of meeting or exceeding those hurdles seems fairly reasonable. It provides a greater opportunity for things like hedge funds, for things like private markets portfolios. And so we absolutely encourage investors to, either if you haven't had those conversations, we will be having those conversations, but there is an opportunity in today's environment. So overall, just in summary, and then I'll start to get to questions here. So first off, it's just not a year to reach, right? It's not a year to reach for absolute risk, or frankly, if you were, one of the, $6 trillion in cash that were sitting on the sidelines and say, hey, now I need to play catch up. It's not the time. In our view, we think there are very few kind of fat pitches just from a broad markets perspective. And a lot of the risks that we described are being influenced by exogenous factors we can't control, right? It could be policy or policy error, it could be geopolitical. And so, those are certainly hard to time and hard to predict. The second is, because of that, and frankly, just good housekeeping no matter what, it's important to sit and look at the overall risk of the portfolio and say, does this reconcile with the ability of the risks that I can take in my portfolio? Whether you build model portfolios, whether you have a very specific targeted risk or targeted return, because the last 2 years, the S&P has been up over 20% back-to-back years. If there's a time to say, what, my risk posture might have got extended here, now's the time to do it. It's not when markets are down, in a material way. That's the time where you buckle up, you hold in, and you say, what, now's actually the time to, be adding to equity. So it's a healthy exercise to confirm those. Inflation, we won't repeat too much of that, but it's just the fundamental factors and policy factors that have skewed that risk upwards. Not that we're calling for 9% inflation in 2025, but we think that if the risk is skewed in one direction, it's started to move that way, and that leads us to this kind of overall positioning of prioritizing durable return, being mindful of the impacts of inflation and leaning on alpha, whether that's kind of traditional long only stock and bond portfolios or those other alternatives across the board. So I know we have a number of questions, and I'll pause there, and maybe as our compliance team reviews this, that we get our final slide and thank you and disclosures up. But Sabrina, what questions came across the queue that make sense to hit out of the gate?
Yeah, so there's a couple on international, Brad, in terms of international equities. One was, is there any concern with the increase in US companies' revenue percentage coming from overseas? And is there an argument to be made that there may be too much exposure and potential volatility within US companies?
Yeah, it's a great question. It's one that, we've had a couple of colleagues take a deep dive into that concept over time of just where you derive your revenue. So you're based in Tennessee, but you get the majority of your revenue from the UK. Does that matter or not? It does matter, obviously, company by company, but overall, the cohort of the S&P 500 is not going to start trading like emerging markets just because US companies sell goods in emerging markets. So it's important. And if you're a stock picker, right, you're trying to pick one company or the other, understanding those sources of revenue and potential flow throughs and the macro environments and the ability to spend and purchase those goods. But from a beta at that kind of level, it doesn't end up being that impactful.
Good, thank you. The second question was, we've been waiting for international to outperform for almost a decade. How should we think about that international outperformance?
Yeah, I knew this question was going to come. I actually, we even put together a slide on it to just address it. And, whomever asked that question is exactly right. It's been a long time coming. If you look at, and you can cut this in almost any way, but S&P as a percentage of nominal GDP or of the world market cap or just, rolling returns, it has been, US exceptionalism, period. If I would almost say if you read Cliff Asness' recent piece on his outlook, he did it from 2035 looking back and kind of tongue in cheek. Um, you know, it's especially when the world thinks it's hard to envision that anything can happen other than a handful of stocks in the S&P outperforming. That seems even more compelling of why you would want to do quite literally the opposite. Valuations again is a good spot to start, but it's not a great spot to end a conversation. Relative earnings outside the United States and growth and opportunities certainly continue. And then remember, for being a non-US investor, we don't have to own all of the EFI and all of EM. Actually, we tend to be mostly active in those areas. In a given calendar year over the last decade, more than 60% of the best returning stocks in the world have come from outside of the United States. And that's been in a period of time in which the S&P has been the very best game in town, period. So there is and continues to be a lot of opportunity. But also, as we just think about those key risks, valuation, inflation, and concentration, inflation risks are far less acute outside the United States. Concentration is much less lower, and valuations are at a very materially different level, i.e., much lower than they are here in the US.
Thank you. And I know we just have a couple minutes left and we won't get to all the questions. So if we don't, definitely reach out to your advisor and then we will look to respond to you as well. But Brad, another question came around private credit and what our thoughts are on private credit allocations and what risk factors they face in 2025.
Private credit is obviously it's been the belle of the ball, has received a ton of attention and interest from investors. We noted or we mentioned in our credit allocations, both kind of traded credit, broadly syndicated loans, or just publicly traded high yield, and muni high yield. Credit today is not offering a whole lot of spread above and beyond the risk-free rate. Um, our expectations for private credit are still higher than public markets because there's a bit of an illiquidity premium there, and you can demand and compel a higher return premium. But a lot of those businesses are quite indebted. Their average leverage is much, much higher. And the spread today that's being compensated for those positions is fairly modest. So much like just credit, period, whether it's public, private, muni, syndicated loans, private debt, we just don't think you're being compensated to take a lot of risk there. So if you have positions in private credit or just credit in general, we're kind of hedging towards the bottom end of that just on a relative opportunity basis.
Wonderful. And let's wrap up with one last question. And it's actually about if you want to invest in the S&P 500, how should you think about the concentration risk associated with that as an investor?
Yeah, it's a key question. Um, as we mentioned, that kind of moving walkway example, the S&P, 40% of the S&P is in the top 10 constituents, and largely the direction that they go is the direction of the S&P. It's hard to think of the S&P having a really successful year without those constituents. Moreover, it's hard to think of, the S&P failing, right, when those succeed. And so, unfortunately, there's a bit of a very targeted bet in kind of AI and those top 10 securities. So you can complement the S&P either through global diversification, like we talked about before. By the way, small caps or mid caps, which you have a position in, they're the anti-concentration. I think the largest position in the Russell 2 is 50 basis points or 53 basis points. So, you can complement in those. But if you are worried about concentration and specifically want to own US large cap, that can also be expressed through active management. Ironically, the index is more concentrated than most active managers today. So as you're trying to play whack-a-mole with all of these different decisions, that's one way to potentially address it as well.
Wonderful. Thank you. And thank you all all of you who joined us today. We'll follow up with any questions we didn't get to and appreciate your time.
All right. Thanks, everybody.
Thanks.